Hi guys, welcome back. Today we are going to talk about valuation across the company's life cycle. For valuation purposes, as what the Moderan categorizes the stages of the company's life cycle as follows: young company, growth company, matured company, and declining company. Each stage in the life cycle has its own challenges and issues. We are going to talk about these issues and concerns in each stage of the company's life cycle. The focus of our discussion in this video will be on young companies. How can we say that a company is a young company? A company can be considered young if it is in one of these three early phases. It is still an idea company. Well, idea companies technically do not operate yet. They're still on the research and development phase. From the name itself, an idea company. Considering there are no operations, there will be no revenues and no profits. Startup companies. Startup companies are those that are still earning a very low level of revenues and are incurring heavy losses. Or second stage companies, where the revenues are catching up with costs. However, the company is still to arrive at profitability. A company in any of these three phases can be thought of as a young company. Specifically, the following descriptions categorize a young company. 1 is the absence of history. Being in the initial phase, we are not expected to see a good history of the company, considering it's still in this early phase. Little or zero revenues and operating losses. Again, considering they are still in the early phase, we do not expect that the company will now be profitable. Dependence on private equity. Usually, the founders of the company are the only investors. If not, more likely it would include only their family or friends. And maybe there can be a venture capitalist. Those institutions who are taking the risks that these companies would prosper in the future. We have to understand that majority of these companies are not yet publicly listed. High mortality rate. Most companies in this phase are not expected to survive, will not become mature. Before they become profitable, they are likely to become bankrupt. And finally, its shares of stock lock liquidity. Considering that at this stage, most companies again are not publicly listed yet, the founders of the company, being the investors, would find it hard to sell the shares of stock of the company. For valuation purposes, we typically adjust this with a lack of marketability discount or a liquidity discount. Because of this characteristic, the following are the notable concerns in valuation. Let us start with intrinsic valuation, that is using the discounted cash flow technique. First, we cannot infer how sustainable the revenues are. To project the future cash flows, which will be needed as an input in valuation, we should have a reliable way of projecting them into the future. And it all begins with the revenues being the top line in the calculation. Due to the absence of a history of financial performance, let's say the company is still operational or not, the company is still in existence for only a year or two, it would be hard to use these figures as the basis for the forecast or any projections. This is the reason why it is typically harder to project cash flows for young companies. What can we do in order to do these projections? Well, the best way to do it is to look at the market for the goods or services of the company. We can start by identifying what the product of the company is, whether it's a good or a service. Then let's define the market. Then upon defining the market, we should project a targeted market share the company will be able to penetrate. And through this story, we can develop the initial revenues until its maturity. Another issue, we cannot most likely calculate the beta, and if ever we can, its appropriateness is questionable. You have to understand that in calculating beta, we should be able to have a history of the stock's return to the investors and take its covariance to the overall returns of the market. That is how we arrive at beta. Again, due to the absence of history of this company, we would find it hard to calculate the beta. And furthermore, even if we can calculate beta, we have to understand that beta measures systematic risk. Most of the investors in a young company are not diversified, not because they do not want to, but because they are fully invested in the company that they are owning. As such, it would be not wise to assume that the only risk that matters to these investors are the systematic or market risk. We can actually adjust the discount rate to account for diversifiable risk, considering they cannot be diversified away. Third, most of the company's value would come from the terminal value. We would expect that the next 3 to 5 years would likely give us a very little, if not negative, cash flows. Will give us very little, if not negative, cash flows. We have to understand that it would take time before this company matures, and therefore, we would expect that most of the value, let's say 80 to 100%, or even more than 100% of the value would come from the terminal value. We should determine the terminal date in a way that we can comfortably assume that the company matures at this point. Make sure that the inputs, such as growth rate and the discount rate, are typical for a matured company in that same industry. Remember that this is very important, as most of the value of a young company comes from this terminal value. Then finally, we have to understand that we have to account for survivability. The best way to do this is to project two possible scenarios. One scenario where the company would survive and therefore would make its way to maturity. So we would have the following cash flows until it matures to its terminal value. Then a second scenario where the company will go bankrupt. Project the cash flows, and at the end of the projection would be a liquidating value, an exit value, because the company will go bankrupt. Calculate these two values, and then what we can do is to take the weighted average of these two using the probability of survival and probability of bankruptcy as the weights for the expected value calculation. In relative valuation, there are concerns to be dealt with as well. One is that the variable to be scaled to in the multiple. I'm talking about, for example, in price to earnings ratio, earnings. Earnings, or E, is the variable the value is scaled to. What would be the appropriate variable in the case of a young company? Remember that in young companies, it is unlikely that there are earnings and even sometimes revenues yet. Second is the selection of comparable companies. Ideally, we compare the company with other young companies in that same industry. However, we have to take note that most of the young companies in whatever industry are not publicly listed yet. What can we do to deal with these two issues? This is how we can perform relative valuation in the case of young companies. If, say, we are using the price to earnings ratio, rather than using the current earnings as the input for our multiple, what we can do is to use forward earnings. The earnings as of the point where we can comfortably assume that the company would be matured at that point. We have to apply the average price to earnings ratio for matured companies in our same industry. And then, we have to take note for differences. Young companies are more likely to go bankrupt compared to matured companies. And therefore, maybe we can make a downward adjustment for survivability. Another feature of young companies is that there is a tendency that their shares are not as liquid as matured companies are. So it would be harder to sell the shares of stocks for our young company. We should make a downward adjustment for such as well. To illustrate how this is done, let us refer to the following case. A young telecommunication company is expected to mature by year 5. By this time, it is expected to earn 10 million pesos in that year. Other relevant data includes the telecommunications industry PE ratio, 7 times. The appropriate discount rate, 10%. Price to earnings ratio, remember that this is equal to the equity value over the net income to common shareholders. Given that the average price to earnings ratio for matured companies is 7, we're going to assume that it should be 7 5 years from now. That would give us 7 times is equal to equity value divided by the net income of 10 million. With this, we will arrive at an equity value of 70 million pesos. But remember that this is by year 5. At a 10% discount rate, 5 years from now, we have to bring the value back to as of today by multiplying by the appropriate present value factor. We have 43.46 million pesos, calculated as 70 million pesos times 0.6209. And there you go. In our next video, we are going to talk about the first Chicago method. Thank you for watching. Comment for the future topics that you would like to request. Don't forget to hit the thumbs up button if you like this video, and hit the subscribe and notification bell to be updated for future videos.